In today's video, we are going to look at a client's actual policy and how they're using it for a real estate purchase. When it comes to using a whole life insurance policy to buy and sell real estate, this is something that is extremely popular. People frequently reach out to us. They always have since I've been in this business, specifically interested in how can I maximize the cash value in a whole life insurance policy and then use it for real estate? What are the pros and the cons? So we're going to look at an actual case study today, and what will be nice about this is you'll see an actual policy. He's funded it for 4 years, so it's about 4 years old. You'll see what the cash value has grown to thus far, but then you'll also see what we looked at, what questions he asked, such as, hey, here's my original plan when it came to funding the policy, but now if I'm going to take a large loan against it, when I'm paying that loan back, I don't think that I'll be able to fund it at the original amount that I had planned to. So what's it look like if I reduce my funding while I repay the loan? Then after I pay the loan back, I begin to pay in more. What do the numbers look like? Like, how does that impact my policy? This is something people are often interested in seeing. I know I am, because I want to know if I just keep on doing what I'm doing compared to this alternate strategy, which one gives me the best overall results. So let's take a look at it and have some fun, shall we? So we've got an individual. He started his policy at age 51, and he started about 4 years ago. So he's in policy year 4 right now. And the original funding plan was to pay $200,000 per year for 10 years, which is getting a total of $2 million into the policy. Those are total deposits. The policy is set up with a minimum premium. His actual base premium, which is what the insurance expense is that he's committed to each year, is about $20,000. Then everything else goes into PUAs. You've got a term insurance rider too. But my point is, minimum insurance expenses, maximum cash value, funding $200,000 per year for 10 years. That's the original plan. What he has actually done thus far, you're going to see this on the illustration, which is $850,000. So he's ahead of schedule. Nice work there, because you're going to see strong results as a result. Policy loan, what he is interested in specifically, a $625,000 loan, and his plan is to repay it in 3 to 5 years. He does not like debt. A policy loan is not considered debt in the manner that it doesn't show up on your credit report. You can address it however you want, but at the same time, just when he hears the word loan, he doesn't want to have it outstanding for a long time. So he wants to attack the loan aggressively over the next 3 to 5 years. So we're going to look at a strategy that involves repaying the loan over 4 years. I just picked the one in the middle. We can look at any payback schedule when he actually begins to pay that loan back. But the illustrations we're going to look at are as follows. We've got a policy loan of $625,000, and we're going to repay that over 4 years. Now, we've got cash flow of premium and loan is $200,000. What I mean when I say that is the original funding plan was what? To pay in $200,000 per year. So when he takes out this loan and then begins to repay it over the next 4 years, what I don't want to show is here's what your policy looks like if you continue to pay $200,000 per year plus another $200,000 toward the loan every year. Now, all of a sudden, his cash flow is $400,000 per year, and he'll look at that and say, hey, that's way too high. I want my total cash flow to be $200,000, and I want to repay the loan in 4 years. So what does that mean? That means we need to reduce the original funding that was $200K per year. So what we're going to look at is as follows. We're going to look at reducing the funding while he is repaying the loan, then resuming the funding thereafter. We'll aim to get the same dollar amount into the policy, $2 million. It's actually a little bit more when we look at it, but you'll see 2 different ways in which he can resume funding. We modeled 2 different ways. And then we'll look at a cool scenario, which will display the $625,000 loan, but we're going to assume that he stops the funding altogether, takes that loan, and then repays it over 4 years, but doesn't pay anything else into the policy. Meaning, if I plan to pay in $2 million, but I stop at $850,000 in total payments, what does my policy look like? We're going to see just that. So here's typically what people like to see when it comes to these loans is I want to see, A, what's the impact of the loan? Meaning, If I don't touch it, if I just continue on my current path, let the cash value grow, what do things look like compared to this loan scenario, and then look at them side by side? How much does it hurt me? Or how much does it help me? What's the exact impact? And then to get more specific here, what's the cash value growth? What is the cash value growing by each year compared to what am I paying in loan interest each year? And I said each year can also look at the total loan interest compared to the total growth over time too. We see this a lot with real estate investors, REI, real estate investors, because they want to see, am I in the black or am I in the red in terms of policy growth compared to policy interest paid? So let's have some fun and look at the numbers, shall we? What we have on the left, we'll start with this, is the growth illustration. So what's highlighted in yellow here, years 1 through 4, represent what have already happened. So year 1, right out of the gates, he paid in $200,000, and at the end of the first policy year, his cash value was $175,000 and change. Okay, perfect. Year 2, he planned to pay in $200K, but his actual payments were $175,000. His cash value at the end of that year was $347. Look at year 3, paid in $100, plan was $200, so he's way behind. But then this year, policy year 4, he's made a huge catch-up payment, and this is his projected cash value at the end of this year. His policy year ends in October, so October might be August. My point is, at the end of the policy year is when we'll see it hit that cash value. So he's already paid this in year 4. Total payments, $850,000. Illustrated cash value in year 4, $836 and change. If he gets back on track, which is his plan, prior to the loan strategy at least, back on track at $200K per year, he will be positive, meaning his cash value will exceed his total payments, just over $1 million in, and he's got more than his total payments. And then by age 60, the 10th year in, total payments, $2,050,000 compared to almost $2.35 million in cash value, and a healthy death benefit. And then nothing thereafter, but he's got the option to continue to fund it if he wants. So, a lot of details there. If this is you, what's always valuable to look at when you're looking at loan scenarios is to first look at the growth illustration. Because when you begin to compare the loan illustration or really dig into it, you can see what's the exact impact. Meaning if I don't take a loan, what do my numbers look like? And then what do they look like after I take a loan? Here we've got the loan and repay scenario. What do we have going on here? Well, years 1 through 3 are identical. And the same is true of year 4 regarding the funding. But what's different here in year 4? You've got this annual loan of $625,000. The column to the right, what do you see? Loan balance of $638,000. Why that loan balance is $638,000 in this policy year is because we've got loan interest between now and the end of this policy year of $13,500 that we're assuming he is not paying. Now, knowing him, he probably will pay the loan interest. However, that's optional. And a lot of times when we prepare these models, I do like to show here's what it will look like if you defer interest for some time. So by deferring interest, what happens? The loan balance grows. What happens to your cash value when you take that loan? $198 and change. That represents how much additional money you can take in policy loans. The cash value I like to view as the gauge that determines the maximum amount we can borrow. So pre-loan, $836. Post-loan, we've got another $198 and change we can access. Death benefit, $5.161. Take the death benefit before the loan of $5.8 million, subtract the loan balance of $638, and guess what you'll get? That death benefit over there. So really, how the insurance company continues to pay you, the policyholder, dividends and interest on your entire cash value, because that's a benefit to policy loans. Remember that the life insurance company is still paying me a dividend on any money in cash value, and what's outstanding in loans, I'm getting compounding on the entire balance. How and why they do that is 1, there is a cost to borrow, interest that goes to the insurance company, and 2, the death benefit's collateralized. So if I die with a loan outstanding, what happens to the death benefit? It's reduced, and the insurance company is on the hook for that much less. What's the insurance company's first and foremost obligation? To pay life insurance claims. So, with that said, what do we got next? Well, if we look at the funding in year 5, what's happening here? $25,000. And actually, you'll see it here boxed with the borders there. $25,000 years 7 through 8. Why we did that is as follows. Year 5, you pay $25,000 toward the funding, which is the premium, term rider, and then a little bit left over toward PUAs, but close to the minimum there. Then we've got, call it another $25,000 in loan interest, a little bit more than that. And then loan repay, this is a principal payment here, $150,000. So if you tally up those total payments, your net out of pocket, your policy funding, loan interest, and principal, how much did you pay? Just about $200,000. What we were aiming for here is to keep it consistent with this guy, the original plan, funding into $200,000. Now what happens year 6, as you've chipped away at the loan principal, you've got less interest, so we're actually cash flowing it with less than $200,000. So he could decide, hey, if I've got some excess cash, well, I could pay the loan down faster, or I could throw some more money into PUAs. And what a lot of people like to do is ask, which one works out in my best interest? And this early on in the policy, it'll likely be paying down the loan interest. But my point is, he could keep his cash flow consistent at $200,000 per year. But here we just kept it simple. Year 8, $25K funding plus paying off the loan. The balance at that point is $188 and change. So it's a little bit higher than $200,000 in that year, but less in the past 2. Point to all of this. When we repaid the loan, what's our cash value here? $1,050,000. What is it in this scenario? $1.8 million. Big difference though in what? How much have you paid in? $1.65 million versus here, your total funding is $950. So what we did in this scenario, this is what he wanted to see, resuming the funding at $200K per year afterwards, and we get a total of just over $2 million into the policy. So what I want to see, what's the impact here? There you go. Cash value and death benefit compared to over here. Cash value and death benefit. There's a difference in cash value. And significant too. The reason why is because we had 4 years in a row where we did not pay $200,000 in, where over in this example we did. So we're earning dividends and interest on the full payment in this example, where over here we're not. So that's why we're further behind. But again, seeing this up front allows someone really to make an informed decision based on the numbers. And we can pivot as the years pass. This just displays an illustration. What we've got on the right answers that question of interest, meaning how much am I gaining compared to how much am I paying every year. So what do we have here? Yearly interest, annual cash value growth. That's really what I'm looking at. First 2 years were negative. I made a large PUA deposit in year 3. There are fees on PUA payments, which is why I see a little bit lower growth here, because I made a large payment relative to my total cash value balance. But aside from that, let's look at the annual interest cost. Here's what he's paying in loan interest. Why the year he takes the loan out, there's less interest than the next year, is because this interest in policy year 4 is from the month of March through his anniversary date, which I believe is October. It might be August. I've been doing too many of these and I got to look at the report. But my point is, it's a partial year, not a full year, where the next year is a full year on the balance. But what's cool about this is I can see what my yearly cash value growth is compared to my annual interest expense. Am I ahead or am I behind? This works out quite nicely in this specific example. Now, on a yearly basis it does. What about when I look at the total cash value gain, $15,000 and change, compared to the total interest paid? Takes a little bit longer to catch up. The main reason why, because when I look at the cash value growth, I'm still making up for lost time because of the early years where I had that negative hit. That's the main reason why. But eventually in this scenario, he is going to make up for lost time. And just knowing him and his pattern, he's probably going to pay this loan off. And then when opportunities come around in the future, he'll continue to use it and repeat that cycle. But this is an example that displays paying the loan down or paying the loan off and then beginning funding the policy where he originally was. Let's look at another one quickly here, which is the exact same loan scenario, but look at the funding column. What do you notice here that's different? We reduce the funding while we are servicing the loan. What about afterwards though? Well, then we began to aggressively fund the policy. And he did ask to see this. Now we ran the funding at 375. Why I plugged that number in is because that's the highest dollar amount he's paid in. If he wanted to, he could say, hey, can I just throw in the balance here and get myself back to the 1.85? Or could I go all the way up to the $2,050,000 by year 8? Say I sell the property and I've got a significant gain. Can I just make a big lump sum catch-up payment? The answer is yes. He can do that with how the MEC limit works. We've got rollover space. We've had a lot of individuals do that with their policies. My point is, instead of illustrating that, which would look really cool, we said, all right, well, here's the max you've ever paid in. What if you do that for a couple years? And the last year is $350 because that matches the funding at $2,050,000 compared to the original plan. Really what I want to look at here is the total cash value and death benefit. But you'll notice this example is much closer than the last one because we're aggressively getting money in. And we can look at it long-term too. You can look at the same thing with the loan interest. There won't be much difference there, really no difference at all, because while we are paying the loan down, the funding is $25,000 per year. It was identical to the last scenario. So your funding is the same, your loan treatment's the same, therefore the yearly cash value growth and yearly interest paid, same when we look at the totals, that won't change at all. One more scenario and then we'll wrap up. The last scenario is what does it look like if I stop funding altogether? So what we've got here is a pretty cool scenario. We ran this illustration, assuming no more payments ever, not even the premium. So total funding is now $850,000. The loan's identical, takes out $625K, pays it back over 4 years, okay? So here's where this gets interesting. Annual cash value growth. What do we look like there? Just about a wash in the first year. And keep in mind, we're not adding extra money. So where that's significant, when we look at the next year, what happened to this column in the prior illustrations for 3 years? Kept going up. Our annual cash value continued to increase. A big contributor to that was the fact that we're adding more money. We're pumping more cash into the policy. So of course it's going to grow by more. But what if we don't do that? Well, it's right around the $27,000 each year, still outpacing the total interest we're paying each year. Perfect. And then how about over here? It's by year 8, when our total cash value growth, the total gain, which is $106,000, that comes from this fact that you paid $850. You've got that $150 plus another $100 back on top of it. That says $106. The reason why, look at this. Here's your cash value in the model where we repaid the loan. It's a little bit higher than the example where we let it sit and grow. You know why that is? If we whipped up the detailed illustration, we would see it with a dividend column. So this is an older Guardian policy with a fixed loan interest rate at 6%. What that means is outstanding loan dollars still receive a dividend, but of 6%, whereas non-leveraged money receives a dividend of 5.75%. So there's a slight positive spread, or I should say the dividend is slightly higher on borrowed funds compared to non-borrowed funds, which is why we see it slightly higher. The the cash value that is once we repay it compared to the growth scenario. We don't have a positive spread. I want to correct that piece because the dividend, even if it's 6%, your fixed loan interest rate is 6%, that's a true 6%. Whereas a dividend of 6%, if we run an IRR here, might come out to 4%. It'll be a little bit higher than that. But that's a whole different conversation, which we've got other videos on. Anyway, I hope you enjoyed this video. It has a lot of numbers, was a little bit technical, hopefully not too technical. But the purpose of these case studies is really, if you're using a policy, what we have found most people like to see in the questions they have is, what's the overall growth compared to what I'm paying in interest, and what's the best strategy really to maximize my dollars? Because what I don't want to do is make a decision, I'm told it's a good decision, but then find out after the fact it could have been a little bit better. That's the kind of thing we want to avoid. So I hope you enjoyed this video. If you did, please hit the like button, subscribe for more, leave any questions or comments below, and as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.